NLY Capital Management delivered a definitive earnings beat for the second quarter of 2026. Net interest income came in at $488.2 million, and earnings available for distribution, or EAD, hit 79 cents per share.
Right, and that EAD actually outpaces their dividend for the ninth consecutive quarter, which is just incredible consistency.
It really is. And looking at guidance, management signaled just immense confidence by increasing that quarterly common stock cash dividend up to 75 cents a share.
Yeah, and the stock's underlying value reacted exactly how you would hope after a report like this. I mean, book value now sits at $20.15 per share.
Which drives a very healthy 5.5% economic return just for the quarter alone.
Exactly, and that brings their total economic return for the first half of the year to a staggering 6.9%.
Yeah.
I mean, when you consider the macro headwinds out there right now, those are figures that demand a serious look under the hood.
And that is our exact mission for this deep dive. As two financial analysts speaking directly to you, the retail investor, we are going to tear into the mechanics of this report.
Yeah, we are moving way past the headline numbers today.
Right. We want to unpack exactly how NLY generated these returns across their portfolio segments. We'll parse the management commentary, and crucially, we're going to map out the very real macro risks testing this portfolio right now.
Because there are plenty of risks out there.
Absolutely. So let's dive right into the core engine of their balance sheet because, well, that is where the bulk of these returns are manufactured.
Right. You're talking about their agency mortgage-backed securities strategy.
Exactly. The sheer size of this segment is honestly hard to wrap your head around. It sits at $95.0 billion.
Yeah, it's massive. That represents, what, 87% of NLY's total assets?
Yep, 87% of assets and 57% of their dedicated capital.
It is the gravitational center of the entire company.
I like to look at this $95 billion agency portfolio like a giant cargo ship. I mean, it takes an immense amount of capital to get it moving, but once it is, it provides this incredible, relentless forward momentum for the company's earnings.
Because it is backed by government-sponsored enterprises, right? So the actual credit risk...
The risk of default, yeah.
Yeah, the default risk is minimal. That is the wind in the sails.
But a ship that massive cannot stop on a dime. I mean, if the economic weather changes, you can't just sell off $95 billion in assets. You have to steer it.
Right, you have to use smaller, highly agile tugboats to navigate around all this interest rate volatility we're seeing.
Exactly. So looking at the Q2 data, how is management actually steering this thing when it comes to risk and leverage?
Well, it comes down to highly disciplined navigation, and the Q2 report highlights a really interesting divergence in their leverage metrics that kind of tells that whole story.
Oh, the gap versus economic leverage.
Yeah, so gap leverage actually crept up slightly, moving from 7.3x in the first quarter to 7.4x. But, and this is the metric you actually want to watch, economic leverage decreased.
It went from 5.7x down to 5.6, right?
Exactly.
Wait, let's pause on that divergence for a second, because for a retail investor, that can look contradictory. Gap leverage is what is printed on the standard balance sheet, right? Just raw debt to equity.
Right.
But economic leverage is lower here, which means they are adjusting for off-balance sheet items. Why does economic leverage give us a truer picture of how much risk they're actually taking?
Well, because gap leverage is essentially a snapshot that just doesn't account for the complex hedging and forward contracts a modern mortgage REIT uses. Economic leverage factors in their to-be-announced, or TBA, position.
And a TBA is basically a forward contract.
Yeah, exactly. You are agreeing to buy a generic pool of mortgages at a future date at a set price. It gives you market exposure and yield without immediately putting all your physical capital on the line.
Ah, okay.
So by factoring in these positions, alongside their hedges, economic leverage gives you the actual real-world capital at risk. The fact that economic leverage is trending down to 5.6x, even as the overall portfolio grows, tells you they're actively de-risking their profile.
They aren't just blindly layering on more debt to chase yield.
No, not at all.
Which brings us to the tugboats in our cargo ship analogy, their hedge positioning. The report notes they are operating with a massive 97% hedge ratio.
Yeah, 97% is huge. That means they are leaving almost nothing exposed to the raw whims of the yield curve.
But the mechanics of how they achieve that are fascinating to me. They noted they were primarily adding swap exposure across various tenors. Break that down for us. What does it mechanically mean to add swap exposure across tenors?
Okay, let's look at the basic mechanism of a swap first. NLY owns $95 billion in fixed-rate mortgage assets, but they finance those assets with short-term floating-rate debt.
Right, the classic borrow short, lend long model.
Exactly. So if interest rates spike, their borrowing costs shoot up, but the income from their assets stays exactly the same. That's a massive margin crush.
Right.
So they enter into an interest rate swap, they agree to pay a fixed rate to a counterparty, and in exchange, they receive a floating rate.
So if rates spike, the floating rate they receive from the swap goes up, which perfectly offsets the higher borrowing costs on their debt.
Precisely. They're essentially buying insurance against rate hikes.
Okay, that makes sense. But what about the across various tenors part?
Right, so tenor simply means the length of time until the contract expires. They aren't just buying one-year swaps, they are laddering them.
Like 3-year, 5-year, 10-year swaps.
Exactly. By spreading these out across different time horizons, they are building a bridge over the next few years of macro uncertainty. They are locking in their borrowing costs no matter what the Federal Reserve decides to do.
So the ship is heavily armored. But armor is expensive, right? And it drains capital. The report highlighted that they grew the agency portfolio by nearly $3 billion, deploying capital specifically into higher coupon TBA securities and specified pools.
Yeah, they did.
Why spend heavily on specified pools right now?
It is entirely about prepayment protection. Let's define a specified pool really quick. Unlike a generic batch of mortgages, a specified pool has very particular characteristics.
Like what?
For example, NLY might buy a pool made up entirely of low-balance loans, say, mortgages under $100,000.
Why does the loan balance matter so much?
Think about the homeowner's incentive. If you have an $800,000 mortgage and rates drop by 0.5%, refinancing saves you a massive amount of money.
Right. It's totally worth the hassle.
Exactly. But if you have an $80,000 mortgage, the closing costs and the paperwork to refinance will completely wipe out the tiny bit of interest you save.
Oh, wow. So low-balance borrowers rarely prepay.
Right. So NLY pays a premium to buy these specific pools because it guarantees the cash flow will remain stable even if rates suddenly drop. They're buying highly engineered predictability.
Okay, so they are spending heavily to armor the $95 billion engine against both rate spikes with swaps and sudden prepayments with specified pools.
Exactly.
But buying premium pools and maintaining a 97% hedge ratio, I mean, that drains capital. Where's the cash flow coming from to offset that cost?
That brings us to their alpha generators.
Right, the segments that sit on top of the agency engine. Let's start with the mortgage servicing rights, or MSR portfolio. It currently sits at $4.1 billion in market value.
Yeah, $4.1 billion.
Now, I'm going to push back on this strategy because any critical investor needs to ask this question. We have short-term yields lifting. We have a highly unpredictable rate environment. Isn't holding over $4 billion in servicing rights a massive vulnerability right now?
I mean, historically, MSRs are heavily sensitive to market swings. So you would think so. But the mechanics actually work in reverse in this specific environment.
Really?
Yeah, the MSR portfolio is functioning as a brilliant natural shock absorber. It is the perfect counterweight to the agency portfolio.
Walk us through that mechanism. How does holding a servicing right act as a hedge?
Well, think about what a mortgage servicing right actually is. Annaly isn't holding the loan itself. They own the right to handle the administrative work, like collecting payments, managing escrow.
And they get paid a fee for that.
Right, they get paid a steady fee for as long as that mortgage exists. Now, what happens when interest rates stay high, like they are right now?
Nobody refinances. I mean, people hold on to their 3% mortgages for dear life because a new one would cost them 7%.
Exactly that. Prepayment speeds grind to an absolute halt. And if prepayments slow down, that mortgage stays on the books for much, much longer.
So the lifespan of the MSR extends dramatically.
Yes. Because they are collecting that servicing fee for a longer period, the total cash flow generated by that asset increases over time.
That's fascinating. High rates hurt the value of fixed income bonds, but they actually increase the value of mortgage servicing rights.
They do. The report explicitly states that Annaly's MSR portfolio valuation increased marginally quarter over quarter, and that was driven directly by this slow prepayment environment.
Plus, they noted that delinquencies remain muted. Homeowners are making their payments.
Exactly. And they aren't just passively holding these things. Through their Onslow Bay subsidiary, they are actually the fifth largest non-bank servicer of agency MBS in the country.
Wow, fifth largest.
Yeah. They noted that while bulk MSR trading volume decreased slightly in Q2, pricing remained incredibly stable. It is a highly valuable cash-flowing asset that thrives in the exact same environment that stresses their main portfolio.
Okay, that mechanical counterbalance makes complete sense now. Let's move to the other alpha generator then, the residential credit segment.
Let's do it.
This portfolio sits at $10.4 billion. But looking at the quarter-over-quarter numbers, it remained effectively flat. My instinct says a flat portfolio is a stagnant asset. Why should an investor be excited about a segment that is just sitting there?
Because the flat balance hides an incredible amount of internal velocity. It is not stagnant at all. It is a highly efficient manufacturing engine.
A manufacturing engine.
Yeah. NLY Residential Credit Group is the largest non-bank issuer of Prime Jumbo and Expanded Credit MBS. This quarter alone, they priced a record 13 securitizations totaling $6.8 billion.
Yeah, I saw that in the report. And year to date, it is 25 securitizations totaling over $14 billion. But wait, if they are securitizing and selling that much volume, how are they actually making money off it?
Here is the aha moment for this entire segment. They are capturing the manufacturing margin.
Okay, explain that.
Most funds have to buy high-yield, risky assets at a premium on the open market. NLY acts as the factory. Through their correspondent channels, they aggregate thousands of individual whole loans.
Right.
Then they bundle them together and slice them into tranches or layers of risk to create a securitization.
Like slicing a cake, where the top layers are the safest and the bottom layers carry all the risk.
Perfect analogy, yeah. They sell off the top layers, the safe, AAA-rated tranches, to institutional investors who want low risk.
Okay.
By selling those safe pieces, NLY basically recoups their initial capital. But they keep the bottom layers, the subordinate tranches. These are the riskier pieces, but they carry massive, massive yields.
So rather than going into the open market and paying a huge premium for a high-yield bond, they build the entire structure themselves, sell off the boring parts, and keep the highest-yielding pieces at cost.
Exactly. They control the credit quality, they dictate the structure, and they retain the pieces that offer the absolute best risk-adjusted return.
That is brilliant.
It really is. That $10.4 billion portfolio isn't sitting still. It is constantly recycling capital through this factory, throwing off massive yields. It is a massive mechanical differentiator compared to peers who only operate in the secondary market.
So we have the $95 billion agency cargo ship providing the momentum, the MSR portfolio acting as the shock absorber, and the residential credit factory generating high-yield alpha. That is the internal setup.
Right.
But no ship sails in a vacuum. Let's transition to the macro landscape. How are external forces testing this $109.4 billion total portfolio, and how is management positioning against them?
Well, the external environment is the ultimate judge of an REIT's strategy, right?
Yeah.
You can have the best portfolio construction in the world, but if you misread the macro environment, your borrowing costs will just crush your margins.
And it seems management is aggressively preparing for heavy weather. During the quarter, NLY raised $447 million of accretive common equity through their at-the-market, or ATM, sales program.
Yeah, that's a key move.
Let's clarify that term for the listener. What makes capital accretive in this specific context?
When an MREIT issues new shares, they want to do it when their stock price is trading above their book value. An ATM program allows them to trickle shares into the open market at the current market price, rather than doing one massive discounted secondary offering.
Got it.
Because they sold these shares at a premium to their underlying book value, the cash they brought in actually increased the overall per-share value for existing shareholders. That is what makes it accretive. It adds value while raising cash.
So they are keeping their powder dry and reloading their capital cannons. They are building a war chest. But why right now? Let's connect this liquidity to the Q2 economic developments management highlighted. They point to firm inflation and a stable labor market. How does that directly impact NLY?
It changes the entire interest rate trajectory. Earlier in the year, the market was pricing in aggressive rate cuts from the Fed, but because the labor market stayed strong and inflation remained firm, those expectations just vanished.
Right, the cuts got pushed back.
Exactly. That shift lifts short-term yields.
Yeah.
And remember, NLY relies on short-term debt to finance their operations. When short-term yields rise, their borrowing costs rise.
The report identifies some specific drivers keeping that inflation firm, too. They mention geopolitical uncertainties in the Middle East, which traditionally disrupts supply chains and keeps energy prices high. But they also highlight a really fascinating technological driver, the AI infrastructure build-out. They claim this is fueling growth even as general consumer spending downshifts. Walk us through that mechanism. How does a data center in Virginia impact a mortgage REIT's bottom line?
It is a direct structural pipeline. The AI boom requires a staggering amount of capital expenditure. We're talking about massive new data centers, vast upgrades to power grids, and intricate semiconductor supply chains.
Yeah, the scale is unbelievable.
And that requires steel, copper, concrete, and highly specialized labor. That level of spending acts as an independent growth engine for the broader economy.
It creates a massive demand shock for raw materials and labor.
Exactly. And that demand keeps inflation sticky. It keeps the entire economy running hot. Even if the average consumer is pulling back on buying a new car or, going out to dinner, the billions being poured into AI infrastructure prevents inflation from dropping to the Fed's 2% target.
And as long as inflation is sticky, the Fed cannot cut rates.
Right. And as long as rates stay elevated, NLY has to pay a premium on the short-term debt they use to finance their long-term mortgage assets. The AI boom is directly squeezing their borrowing costs.
So we have elevated borrowing costs, sticky inflation driven by tech capex, and massive macro uncertainty. If you are CEO David Finkelstein, looking at a $109 billion portfolio, how do you sleep at night with those headwinds?
You sleep soundly because of that liquidity war chest you mentioned earlier. Finkelstein's commentary heavily emphasized their liquidity position. They are sitting on $9.6 billion of total assets available for financing.
Wow.
Crucially, that includes $5.5 billion in pure cash and unencumbered agency MBS.
Unencumbered meaning they own those assets free and clear. Right, like they haven't been pledged as collateral for any loans.
Correct. And that $5.5 billion is both the ultimate defensive shield and the ultimate offensive weapon.
How so? Start with defense.
Defensively, if the repo market seizes up, or if sudden rate volatility triggers massive margin calls on their hedges, they have the unencumbered assets to meet those obligations instantly. They will never be forced into a fire sale, selling off assets at a loss just to raise cash.
They can weather the storm without cannibalizing the ship. What about offensively?
Offensively, volatility creates opportunity. If market dislocations cause MBS spreads to widen dramatically, meaning the assets become extremely cheap relative to their risk, NLY doesn't have to sit on the sidelines.
Because they have the cash ready to go.
Exactly. They have the capital ready to deploy immediately. They can step in and scoop up high-quality assets at distressed prices, locking in massive yields for years to come.
It is the difference between being a victim of market volatility and being a beneficiary of it.
That is the defining takeaway of this earnings report, honestly. When you combine the 97% hedge ratio protecting the existing book with $9.6 billion in deployable liquidity, you have a fortress balance sheet.
Yeah, fortress is the right word.
That combination is exactly what allowed them to navigate the first half of the year and deliver that 6.9% economic return. They are structurally designed to survive the downside and capitalize heavily on the upside.
It is a masterclass in portfolio defense. And the decision to raise the dividend to 75 cents per share is management explicitly signaling that they believe this fortress will hold.
No doubt about it.
Which leaves you, the investor, with a critical, forward-looking question to ponder as you evaluate this space. We saw the pristine $20.15 book value. We unpacked the incredibly defensive 97% hedge ratio and the shock-absorbing power of their MSR portfolio.
But markets are dynamic,
Yeah.
and the macro weather is shifting daily.
Exactly. If inflation doesn't just stay firm, but actually reaccelerates, perhaps driven by an even more aggressive AI infrastructure build-out, or a sudden escalation in those geopolitical tensions, will that 97% hedge ratio be enough to protect their borrowing costs without draining their capital?
It's a huge question.
Or consider the opposite scenario. If the broader economy unexpectedly rolls over and the Fed is forced to slash rates aggressively, will we see a sudden, violent wave of refinancings?
Which would spike prepayments.
Right. If prepayments skyrocket, it would completely rewrite the playbook for their $4.1 billion MSR segment, turning their greatest shock absorber into a depreciating asset. The internal setup is brilliantly defensive, but the external macro environment remains an absolute minefield.
It certainly does.
If you want to stay ahead of these numbers and understand the deep mechanics driving the market, follow the show. We break down the earnings that matter every single day with no filler.